Securities Operations Foundation Qualification, Module 1.1. This is the first section of our training in which we will set the scene in which financial market transactions take place, and so this will be where securities operations live. This section is divided into 4 modules. The first one, being this one, looks at key players in securities markets. In Module 2, we'll take a closer look at debt and equity products. In Module 3, the primary market, and in Module 4, the secondary market. In this module, we will be looking at the international securities markets. We will start by defining what are financial securities. Then we will move on to discuss the market participants, the issuers, investors, and intermediaries. Let's start with our definition. International securities are financial products that evidence money moving within the market. We will see that they come in different forms and that these forms will give different rights and obligations. These securities come about through a process that we call disintermediation. Traditionally, if someone were looking to raise money, they would go to a bank and they would borrow it from the bank. Under a disintermediated model, we are still going to see a bank or other financial institution involved in the deal, but this time they're going to raise funds for the borrower. They will do this by finding a lender. The lender will have the funds, and they will match this with a borrower looking for money. The funds will then flow directly from lender to borrower, all facilitated by the bank, who has expertise in how best to achieve this, which will be ideally through creating financial securities. So in this example, the borrower issues a security that is then bought by the lender. These securities will have a couple of key features. The first is that they will be transferable, meaning the lender, the buyer of the security, can sell it on to someone else. This is what we will go on to call providing liquidity. The second is that they will be negotiable in value. Obviously, if we're selling them on potentially lots of times at different points in time, they will be more or less attractive, and this will be shown in the price that is negotiated. These securities will then trade in our financial market in deals executed by market participants. Let's look at who are these participants. They will fall into 3 categories: issuers, investors, and intermediaries. Let's look at each of these in turn, starting with the issuers. As we saw in the diagram, these are the ones wanting to raise funds, raise money in the market. They can do this in either of 2 ways. They can borrow money, as we showed in our example, but alternatively, they could issue equity, sell part of themselves. This means they're raising money on a permanent basis if they can issue equity, or on a temporary basis if they issue debt. We will go on to see in the next module, where we focus our attention on the products, that these are very different ideas, and not all issuers can use both mechanisms. It depends on who they are. So now let's think about who are the issuers. First off, we have countries, governments. Governments are major issuers of financial securities, although they are a perfect example of an issuer that cannot issue equity. You can't buy shares in Germany. Instead, they can only issue debt, which they do on a regular basis. Next, we have cities, regions, a group that we generically call quasi-sovereigns. These are entities that are not countries, but are linked with countries. Again, these issuers cannot issue equity. They can only borrow money. We said you can't buy shares in Germany. By the same token, you can't buy shares in Frankfurt. Our third example is supranational agencies. An example of this would be the World Bank, or the EIB, who are both very large issuers in the markets. These agencies are both development banks, and they're both owned by more than one country. So again, they cannot issue equity, only debt. So now we have 3 examples of types of issuer in the market who can't use the equity market, but only the debt, which shows you a large bias in the market. We'll find a lot more debt deals being brought to the marketplace rather than equity deals. Our next example is banks. Banks are able to issue both debt and equity, and we'll see them very regularly issuing securities. Finally, we have corporations. Again, corporations can issue debt or equity as they choose. One thing we will say, though, is that most of the corporations who use our international financial markets will be large, very often multinational corporations. This has a lot to do with the reasons that issuers use financial markets. The first point is that financial markets are for raising funds for capital projects. Indeed, we call this the capital markets. So to use this market, it will make sense that the issuer has a requirement to raise funds for a capital project. Financial markets are also about raising wholesale funds. Wholesale funds being large amounts, normally hundreds of millions or billions of dollars, or other currency equivalent. Again, this explains why our corporate issuers will be large corporations. They're the ones who need this size of funds. An issuer may issue a very large-sized deal, let's say $1 billion, but this won't be sold to one investor. Instead, it will be sold to a number of investors. The deal will be fragmented. This allows us to find many potential investors, bringing many potential sources of funds. Let's move on then to look at investors. These are the providers of funds. They will be the buyers of the financial securities, fulfilling that movement from those that have to those that want. When an investor decides where and how to invest, they'll consider two things: the risk of the trade and the return they will receive. Given the list of issuers we've just considered, and that we have the choice of debt or equity, we can start to appreciate the range of risks and returns that will be available, the breadth of the market. If we couple this with having investors with different appetites for risk and return, we start to understand how our market can function, moving money from investors to issuers of all types. When we look at investors, we can see they fall into two main groups. First, we have individual investors, and then we have institutional investors. Let's look first at individuals. This group is also known as retail. Retail, by contrast with wholesale, means small size. So this tells you that most individual investors will be providing small size funds to our issuers. So since individuals normally trade in small size, each of their deals is rather insignificant. However, if we add them all together, we find they're not insignificant. Their significance comes in aggregated size. Institutional investors are firms that trade wholesale in our markets. We'll see that they trade for themselves, and they also trade on behalf of others, managing other people's money. Generically, we're going to call these asset managers. Looking first at some self-investors, we'll see that our governments and our quasi-sovereigns will be investors as well as issuers. They all need to keep some money in their reserves, governments more so than quasi-sovereigns, and this money will need to be invested. The same is true of supranational agencies. Although for the most part their purpose is to fund development projects, they will still need to maintain some levels of cash. And yet again, the same is true of banks and corporations. Whilst in most cases they are what we call net borrowers, in other words, they have more need for funds than they have funds to invest, there are exceptions. So all in all, we find here all of our issuers. Moving on to asset managers, we can see some different types of companies. The first we have here are pension funds, who are managing money to provide for their customers' pensions. These can be in-house pension funds, the funds of a particular company, but there are also firms who manage pension funds on behalf of a number of companies. They provide expertise in financial markets to try and achieve the best returns. Second, we have insurance companies. Insurance companies sell policies and need to invest in financial markets in order to ensure that they have the funds to pay out on these policies, if necessary. They also run saving schemes, particularly for those retail investors who prefer to invest indirectly rather than directly in the market. This idea of indirect investment leads us to our third example, what we call asset management companies. These are firms who run client portfolios. These can either be managed money, investing on behalf of a known client, or collective investment schemes. These latter are where the company designs a portfolio of investments and invites people to place their money into a fund to buy part of this whole portfolio. These investors will be institutions, or again, individual investors. Typical products are things like mutual funds and investment trusts. To give a sense of the size of this market, the biggest asset management company is BlackRock, with more than $6 trillion under management. Of course, we need to ask why investors use financial markets, and the biggest reason is variety. Think about the different issuers we've identified, and we start to get a sense of the variety of homes for their money. We also have a wide range of products, all with different risks and returns. So from this, we can see how they can build up diversified portfolios. Our last group of participants are the intermediaries. These are the firms that put buyers and sellers, borrowers and lenders together. In our market, we will see them with two roles. Initially, they will make the securities that we've been discussing. This is the primary market. But they don't stop there. Going forward, they'll be involved in the secondary markets, providing liquidity by finding new investors if someone wants to come out of a deal, and sometimes stepping in themselves to take on the risk. We will look at the primary market in Module 3 of this section and the secondary market in Module 4. Most of our intermediaries will be banks, specifically the investment banking parts of banks. Financial markets is an investment bank activity. We do have some non-bank financial firms, but they tend to be more specialist, for example, specializing in equities rather than debt, whilst the banks are more generalist. In terms of why intermediaries are involved in financial markets, the biggest reason is going to be to generate profits. This is a profit-making business for intermediaries. We should say, though, that financial markets is very much a relationship business, and a large part of what the intermediaries do is to provide a service to their customers, helping issuers to raise funds they need and helping investors find a home for their funds and earn a return. The last point is about raising the profile of the firm. We'll see that financial securities are most commonly issued in the public domain, so everyone can see and follow the securities. This will often mean that the intermediaries that bring the deals to the market will be linked with these deals and so raise their profile. Before we go on, we should check if there are any questions. Don't forget that we have the discussion board where you can post any questions that you may have. Finally, let's conclude our module. We've been looking at market participants. We've been looking at issuers, investors, and intermediaries. You should make sure that you're happy with what they are, what they do in the flow of financial market products, and why they are in the market. Before you go on, you have 3 questions to answer before you can move on to Module 2. In Module 2, we will be looking at the products themselves. This will be the same at the end of every module, just to make sure you're building up your knowledge and building up your confidence.